If there's one goal that most of us share, it's to achieve financial freedom and retire comfortably. However, when, what, and how to get there are all personal choices. No matter the choice you make, though, to build financial freedom, you must first define your goal and then use the right strategy to get there. You've probably heard of a few different strategies, but they all boil down to keeping your spending and saving habits in check. They work by spending less, saving more, and investing the difference if you have a well-thought-out financial plan and strategy. The 50-30-20 rule is one of the simplest yet most effective strategies that follows this methodology for achieving financial freedom. It helps you in categorizing your income into three major categories: necessities, wants, and savings. Because the rule is based on percentages, not fixed on a specific amount, it's great for your income whether you're a college student, a young professional, or an established entrepreneur. Anyone can use it, and we'll show you how. Category 1, necessities. Necessities are the first category, which includes all of your essential expenses. These are the bills and payments you cover to maintain a stable lifestyle. They include rent, utilities, groceries, transportation, insurance, minimum debt payments, and any other unavoidable cost. The goal of this category is to keep these expenses within 50% of your total income. For example, if your monthly income is $3,000, then the total allocation for necessities should not exceed $1,500. If your necessary expenses consistently exceed 50% of your income, it may be time to reevaluate your spending habits and see if and where you can cut back, even if it means finding more affordable housing, reducing utility consumption, or making smarter grocery choices. To do this correctly, you have to make a clear distinction between necessities and wants. That way, you can make informed financial decisions and ensure that your essential needs are met before focusing on non-essential expenses. Category 2, wants. This category involves all the non-mandatory choices you have, including discretionary spending, such as entertainment, travel, hobbies, and other non-essential expenses that bring joy to your life. Here, you allocate 30% of your total income and spend responsibly. This percentage ensures that you have room in your budget to enjoy the fun aspects of life without compromising your ability to cover necessary expenses and save for your future. Life is short, so even while you're striving for financial freedom, have as much fun as you responsibly can. The idea here is that 30% should allow you to strike a healthy balance between enjoying the present and securing your financial future. Category 3, savings. Saving is a crucial foundation of financial freedom and securing the future you desire. Set aside at least 20% of your earnings for savings, which can be invested or used for an emergency fund, retirement, or other long-term financial goals. You should start early to take advantage of the potential of compounding interest. When you invest your savings, your money grows not only as a result of your contributions, but also as a result of the interest earned on your assets. Compounding increases the value of your savings over time, giving you an advantage in your pursuit of financial freedom. So while 20% might seem small in the short term, it has the potential to create incredible returns. Practical tips to implement the 50-30-20 rule. Now that you understand the rule, let's discuss some practical tips to implement it effectively. Track your expenses. In truth, tracking your expenses is a critical step in efficiently adopting any kind of budget rule. It entails keeping track of all your financial transactions in order to get a clear picture of how you spend your money. Keeping track of your expenses is essential since it helps you to understand exactly where your money is going, what you're spending it on, and even why you're spending the way that you do. Many people need to know where their money is going since they only have a basic idea of major expenses, such as mortgage payments, but they typically disregard smaller, more frequent purchases that can add up over time. By logging all of your expenses, you gain complete visibility into your spending habits, allowing you to identify areas for improvement and make informed financial decisions. Automate savings. One of the challenges people face when saving money is maintaining consistency. Life can get busy, and it's easy to forget to transfer money into savings regularly if you're doing it manually every time. Automating your savings eliminates this obstacle. Once you set up automatic transfers, a predetermined amount of money is automatically moved from your checking account to your savings account on a regular schedule, such as weekly or monthly. This consistency helps you build up your savings steadily over time without requiring your discipline. Automating your savings allows you to adopt the pay yourself first principle. Instead of saving after covering your expenses, you prioritize saving by making it the first financial action you take when you receive your income. By doing so, you ensure that your savings are a priority and not an afterthought. Reduce unnecessary expenses. By regularly reviewing your wants category and identifying areas where you can cut back without compromising your happiness or well-being, you can free up more money for savings and important financial goals. Otherwise, impulsive expenditures can quickly mount up and wreck your budget if left unchecked. To save money, practice conscious spending and avoid making rash purchasing decisions. Before making a purchase, assess whether it's in line with your financial goals and whether you truly require the item or experience. Increase savings as income grows. Rather than letting lifestyle inflation creep in and spending more on non-essential items, consider allocating a higher percentage of your increased income to savings or investments. This is the key to truly building wealth. This proactive approach allows you to make the most of your higher earning potential and set yourself up for a more financially secure future. Emergency fund. Create an emergency reserve of at least 3 to 6 months of living expenses to cover unforeseen bills without throwing your budget off track. This may not feel directly related to the rule, but it's important for several reasons. Something unexpected will happen. It's probably the one guarantee in life we have. Building yourself a buffer with an emergency fund will ensure that you won't be caught unawares, nor will you have to go into debt or dip into your investments to try and handle the situation. Having an emergency fund also gives you the confidence to take some calculated risks, knowing you have a little cushion to fall back on. Benefits of the 50-30-20 rule. This rule can help you have a better grasp of your financial condition and avoid overspending by tracking your expenses and allocating your income in specific ways. It can also help you save money by allowing you to set aside a certain percentage of money each month, with a chance to progressively increase your savings over time. In addition to increasing your savings, the 50-30-20 rule can also help you pay off debt. You can lower your debt and improve your credit score by allocating a portion of your income to debt payments. But one of the biggest strengths of this rule is because it's based on percentages, it will work with a steady paycheck cycle or an inconsistent income schedule. Having such a flexible rule will allow anyone, regardless of the type of income they have, to get ahead on their path to financial freedom. Is the 50-30-20 rule right for you? For many people, the 50-30-20 rule is a reasonable starting point, but it may not be appropriate for everyone. If you have a low income, a lot of debt, or a lot of expensive hobbies or interests, the 50-30-20 strategy may not be ideal. If you have a low income, you may need to change the percentages. If you have a lot of debt, you may need to devote a larger portion of your salary to debt payments. Additionally, if you have a lot of expensive hobbies or interests, you may need to devote more of your income to wants. Ask yourselves, what are my financial objectives? If you're saving for a down payment on a house or retirement, you may need to set aside a larger portion of your salary. But being able to change the percentages of the rule makes it incredibly flexible. Your version of this rule might look more like 40% needs, 20% wants, and 40% savings and investments. If you're unsure whether the 50-30-20 strategy is good for you, keep track of your expenses for a month or two. This can help you understand where your money is going and how much you can actually save. You can decide if the rule is a good fit for you once you have a better understanding of your money. The most important thing is finding a budgeting system that works for you and can help you in meeting your financial objectives. If the 50-30-20 strategy doesn't work for you, there are other budgeting methods you can try, such as zero-based budgeting, which is best for down-to-the-penny control of spending and saving. Envelope budgeting, which is great for easy customization, categorization, and removing the use of cards to help curb spending and debt. And the Pay Yourself First budget, which highly prioritizes saving and paying down debt, after which you can use the remaining money however you see fit. Don't be afraid to try them out to see which is the best fit for you. If you found this video informative, please give it a thumbs up and share it with your friends. And don't forget to subscribe to our channel and hit the notification bell so you never miss out on our latest video. Thanks so much for watching. See you in the next one.